All right, thank you so much for joining in here. Today we are looking at relevant costs for decision making. Last time we were looking at CVP, cost volume profit analysis, and I hope that you went through the notes. I've not gotten any questions yet, but I hope you went through the notes. I was supposed to send you some practice questions. Unfortunately, I was not able to due to unavoidable circumstances, but I hope we went through the notes. So today we want to interest ourselves onto this topic of relevant cost for decision making. Now, on a day-to-day basis, of course, we make decisions. I already shared these notes with you. I can just share this in the chat box for those that are joining through just a moment. This is it. Okay. So I've tried to share the notes with you just in case via the chat box. But I'd shared earlier, although I just realized the ones that I shared earlier would have been missing something small, but all the same, we are here. So basically, in our introduction, we try to understand more of decision making, and we try to understand what decision making is, as well as the process of decision making. Now, as we continuously dig deep into our paper, Management Decision and Control, it's very important for us to understand that there is what we call relevant costs and irrelevant costs when it comes to decision making. Now, every time you're making a decision in regards to either to maybe start up a new product, either to support a new customer, or either to shut down one of your operations, whatever you want to really do, it will be affected by either relevant costs, of course, relevant costs, and then, of course, along the way, you also have some irrelevant costs. So it's very important for you to know which is relevant and which is irrelevant. Yeah, so that is what we want to look at, especially for today is class. Now, we proceed through. One of the things that you have to know about relevant costs is that they are future in nature. They are future in nature, meaning that the decision you're going to make, once you make that kind of decision, it means that that cost will be incurred ahead of your decision. And that's why we are going to also look at irrelevant costs. And one of the factors, or one of the characteristics with relevant costs, is for them they have happened. Most of them are history. For example, things like sunk costs. Maybe they could be costs that you already incurred before you even made that you come to that point of time where you're going to make the decision. So we have to know that relevant cost is a future cash flow that is arising from a direct consequence of the decision to be taken, or the decision taken. You get it? So we shall try to understand. One of the other things that also happens with relevant costing. Now, this topic, we study about relevant costing, but as you also proceed, when you're making decisions, of course, you get to things like relevant revenues. Of course, relevant revenues are also very similar to relevant costs. In this case, these are like the revenues that will come as a result of you making that given decision. So we shall try to understand once we have different examples for us to appreciate what we really mean. You get it? So it's very important for us to understand. So for examination purposes, you have to assume now. One of the things you have to understand, and this is basically a general principle. We are saying that we now understand variable cost and we understand fixed cost from our previous discussions. Now, As we know that variable costs, these are costs that change with the change in the quantity or change in output and so on. And these are costs that can be directly attributable to products. Now, these variable costs, for them, are looked at as relevant costs. And fixed costs are looked at as irrelevant costs. Now, the reason why variable costs are looked at as relevant costs is because the decision we are going to make will definitely be affected by, will definitely affect our variable costs. Now, for the fixed costs, because these costs are fixed, either we take the decision or we don't take a decision, we shall definitely incur the fixed costs. I'll give you an example. Today, you could be maybe, let's say, dealing in baking and catering. And let's say you get an order from one client who says that maybe your cakes are sold at 80,000 or 50,000, let's say. And this client comes and says, I want to give you, I need over 200 cakes. Yes. Maybe these are Christmas hampers that they are going to give their clients, and they're asking you to charge them 40,000. You get it? They're asking you to charge them 40,000. Now, in relevant costing and short-term decision-making, we call this a special price. Now, this special price, for you to accept this special price, there are decisions that you need to basically make, of course, and things that you need to look at. Now, already, maybe you already have that machine that makes these cakes, you already have the employees, you already have that rent that you pay for that place. Now, ideally, the costs that are going to vary, either you take that decision, when you take that decision, are costs, let's say, around the raw materials in producing, let's say, that cake and so on. Now, they are kind of fixed costs. For example, the rent of the place, you're not going to rent another bigger place, you get, because you can still accommodate within that same place. So the rent, the salaries, which you're not going to increase unless maybe you have overtime that you may increase, all those will be regarded as fixed costs, and they will be irrelevant costs. Reason why they will be irrelevant costs is either you accept this order from this lady, or you don't accept, you still pay those salaries, you still pay the rent as well. And that is why we are saying that fixed costs in this case will be irrelevant. Of course, the other costs, like the cost of raw materials, the cost of wheat, the cost of bread, the cost of maybe yeast, the cost of broadband, and so on, all the ingredients will be variable costs, because at the end of the day, if you don't take that decision, it means you not incur those costs. So they are variable costs and they depend on production. You get it? So those will be relevant. So for us, we shall, when we are making a decision, for example, around special order price, ours is to focus on what are those costs that will change when we actually make a decision in this case. You get it? So it is very important for us to be able to have this on mind, that usually variable costs are relevant costs because definitely they will change with the decision, while fixed costs are irrelevant because they will remain the same all through. You get it? Yeah, so we shall try to understand, I think, when we see more examples for us to know. Now, one of the things that they are also telling us that there are cases where you can have what we regard to as non-relevant variable costs. You can have what we regard to as non-relevant variable costs. Now, you know, in production of, let's say, the cakes I've talked about that this client may be ordering, you could be maybe going to use some materials that you already bought. And these materials maybe you cannot use them for any other use. You get it? Maybe you bought this kind of maybe packing boxes, and you no longer maybe dealing into those specific sizes of cakes. So at the end of the day, the cost of those materials will be regarded as sunk costs. And sunk costs are irrelevant costs in this case. Yes, the materials are variable costs, but in this case, these variable costs are being regarded as sunk costs because they are not relevant to the decision at hand. You get it? Huh? So it's very important for you to also have that in mind, that yes, even if it's a variable cost, it can also be irrelevant. You get it? Yeah. So good for us to also understand. We shall try to look into more. And then, of course, we also have cases where fixed costs can also be relevant. Fixed costs can also be relevant. Now, I'll give you an example. For example, I said, for example, some salaries of, let's say, some workers would be, let's say, fixed, because even if you take on the order, or you don't take on the order, still you will incur the same cost. Now, there are cases where some of the, let's say, the salaries will increase, maybe because you're going to give maybe an overtime payment to certain staff for staying late to meet that order. Maybe you're going to add another supervisor to supervise that kind of production. And so it means that this supervisor will be paid a certain amount of money. So yes, this supervisor's salary may not be directly attributable to the product, but it is coming in because of this new order. You get it? Huh? So it's good for you to understand such cases. All is within the notes here. You can be able to read and try to clarify yourself. You get it? Of course, then we have the general fixed overheads. Now, these ones will remain the same. These will remain the same. The other that we are trying to look at here, under here, you know, remember we're saying we have specific, we have directly attributable, and then we have the general fixed costs. You get it? Eh? And of course, the directly attributable, I've tried to give you some kind of examples. They're saying there are costs with which, although fixed within relevant range of activity level, are relevant to the decision for either of the following decision. You get it? Eh? I've given you an example where you may need an extra supervisor for a particular order, or you may need some staff to remain and maybe serve the company during that time, and maybe you're giving them some amount of money. You get it? Eh? Yeah. So then the general fixed costs, of course, those will remain. For example, rent, those will definitely remain the same. You get it? Eh? Yeah. Okay. So we now get to relevant information for decision making. Now, one of the things that you have to understand, especially with this topic, is that the examiner will bring you a question and will give you a scenario. And the scenario could be like, for example, a special order, say maybe government, because of during this time of the lockdown, I reached out to, last time I used Coca-Cola, and they want to provide, they want them to supply to them water of this maybe quantity in boxes, but government, because of the situation, they're asking for a lower price of this. And then you have to make sure that they also give you more details, and based on those details, you have to make a decision on either to take on the order or not take on the order. You get it? Huh? So we are saying that, remember up, we've just said that relevant costs are futuristic in nature. They are basically future cash flows. You get it? Huh? So yeah, we're just trying to add more information that, of course, if you want to make decisions in regards to your business, what should you consider in the scenario? You get it? What should you consider? If this is being still far-fetched for you, just look at yourself. For example, you are in this position. Maybe, for example, right now you're doing CPA. Right now you're doing CPA, and you can get to a decision where maybe you need to, maybe the job that you're doing right now may require you to have an MBA, you get it as well. So you could be making a decision on either maybe to leave a CPA and maybe go to do MBA, you get it, or to totally leave CPA. Maybe your profession has changed, maybe you're not in the accountancy field. Now you get to an extent that, of course, because you already incurred some costs on the CPA, they will no longer be a factor to your decision, because in that case, there are sunk costs and there are past costs, you get it. So they will not be part of, even maybe the revenue, maybe the salaries you've gotten because of your CPA will no longer be, because now here you're trying to look into the future. This is the job that you have, maybe you're relocating to another country and things don't really work out with you having your CPA qualification, and then you have to make that decision. So relevant information should be basically future costs and revenue. You get it? You know, when we're speaking about relevant costing, we're saying about costs, but also you also need to look at the revenue. What revenue is coming in? Like the order I've just given you, for example, somebody who wants you to supply 300 cakes at a given value of, let's say, 40,000. You also have to look at how much is coming in vis-a-vis your relevant costs that you're also going to incur in that case. You get it? So it's very important for us to have that in mind. So there's an example here. You bought a car at a cost of 10 million 2 years ago. Now, the 10 million is sunk. It's a previous cost, because whether you drive it, park it, trade it, sell it, you cannot change the 10 million cost. You get it? So it's very important. It's just like you have this car and you're now making a decision either to use it for driving, either to trade it, either to, you get it. Now, all these will be sunk because you already incurred the value. You cannot reverse this cost. Now, apart from relevant information being future information and revenue, future costs and revenue, we also have an element of opportunity cost. We also have an element of opportunity cost when it comes to relevant costs, and of course, relevant information for decision making. Now, if today, for example, I will still use the same example. If today a client is saying, supply to me 300 cakes at 40,000, supply to me 300 cakes at 40,000, and that supply itself is going to affect your production of other products. For example, maybe you also produce bread. Now, because it is going to affect the production of your bread, you're going to lose some revenue that comes from bread, because you have to serve this contract. Now, what you're going to lose from the production of the bread, we regard to it as an opportunity cost. You get it? Because you're foregoing a given value, you understand, to be able to serve a given contract. You get, so that is very important. Now, opportunity cost is also a relevant kind of information that supports us when we are making decisions. So in case maybe bread, the bread that we are going to forego, that we're not going to produce because we want to service this contract, maybe this bread was bringing a revenue of, let's say, 20 million. Okay, maybe not, that it could be on a high end, maybe 5 million. Now that 5 million is supposed to be included within our decisions. It's like it's like a loss that we are making because of taking on this other special order contract. You get it? So it's very important for you to have that in mind. You get it? Yeah. So like you're trying to indicate here, of course, even if these are not recorded by the organization, because you not have that anywhere, you as an accountant, as a management accountant, when you're advising management or when you're trying to help management make a decision on this, you have to take it to consideration. You get it? Yeah. So they have also tried to give us an example here for example, around your CPA, that if you are not attending this course, you could be saving maybe 5 million per year. So your opportunity cost for attending this course is therefore 5 million. You get it. So it's important, even still related to your CPA course. Some of you could be maybe generating money right now, but because you're doing this course, you have an opportunity that you're foregoing. So that if you want to make a decision around your CPA journey, you also need to look at how much are you foregoing by attending. Some of you attend this during the weekends, and maybe you have businesses that you could be running during this time. So this is also an opportunity cost in its own. So it has to be part of your decision making. You get it? Yeah. So one of the other X-sticks when it comes to relevant information for decision making is the aspect of differential costs and revenues. Differential costs and revenue. The word differential comes from the word different, meaning that for every scenario, there is a different cost and there is a different revenue. You get it? Now, anything that is the same, any cost that remains the same across different decisions is not relevant. You get it? Huh? I'll give you an example. If somebody was making a decision between, let's say, like we're indicating, like maybe either doing CPA or doing MBA, proceeding with MBA. If there are costs that they are going to still incur, for example, their meals for lunch, maybe transport, and maybe they are going to study from the same institutions. Now, those costs will not be relevant because either you take on decision A, either you take on decision B, you still incur those costs. So they are not differential in nature. You get it? Huh? Yeah, somebody might want to relate them to, let's say, fixed costs. Yeah, they could have a similarity there, but with the differential costs and differential revenue means that a change with a change in decision. If the decision is A, the revenue will be different. If decision is B, the revenue will be different. And the same thing with the costs. You get it? Eh? Yeah. So it's very important for us to have that in mind. There's an example here. You have a job that is paying you 1.5 per month in your hometown. Then you have a job offer up country that pays you 2 million. You get it? They are giving us the commuting cost to town is 300 per month. Is 300 per month. Of course, the differential revenue, we're just trying to get the difference between the 2 million that you're going to earn up country less the 1.5 that you've been earning this side. So your differential revenue is the 500. That is the change. You get it? And that is the 500 that you should make a decision on, not the whole 2 million. The same thing with the differential cost. Maybe in this case, you've been incurring, let's say, 300,000, and now you're not going to incur this. So this is a differential cost. You get it? That you're saving by taking on this job. You understand? Yeah. So good for us to also understand. And then we have avoidable or escapable costs. Now, all this that we are looking at are basically X-sticks of relevant information. You get it? It's just to help you understand more of which information to pick from a scenario. You get it? Eh? Like we indicated at the start of this, not every information that you have at a given time when you're making a decision is relevant. There is information that will be irrelevant. Reason maybe because you already incurred the cost. Reason maybe because that cost will still remain the same, even if you take which alternative of the decision. Maybe it could be, let's say, maybe it's already a sunk cost as well. You get it? So you have to know. Now, any information is also relevant if it is avoidable or escapable. If it is avoidable or escapable. By avoidable or escapable means if we don't make that decision, then we shall not incur that cost. If we don't make that decision, then we shall not incur that cost. So it's important for you to think through and ask yourself that question. What if we don't make this decision? What happens to this cost? Now, if that cost is remains cannot be avoided, either you make the decision or not, then that is not a relevant cost. Like I gave you examples of a contract of somebody who wants you to supply to them those cakes of that tune. If you have already a warehouse, or you have maybe you already have maybe staff that you're paying. Now, if those costs, those staff costs are not avoidable by this decision, and maybe you're going to incur them even if you take the decision or not, then those costs will definitely not be relevant. You get it? Yeah. So very good for us to have that in mind. So as you've seen here, we've been trying to look at relevant costs and what you should basically have in mind. Now, the next thing that we want to look at here are what we call the irrelevant costs. Now, these are costs that in case you find them in any decision-making scenario, you leave them out. You don't consider them. The reason why you don't consider them is because these will remain the same, either you make the decision or not. You get it? So it's important for you to have that in mind, that this one remain the same, either I make the decision or not. You get it? Now, in this scenario, we are saying that irrelevant costs, of course, these are not relevant to the decision, and we are starting with sunk costs. I already spoke about sunk costs. When you hear the word sunk cost, just know that this is a past or historical cost. You already incurred it. It's no longer relevant. You get it? You should be able, if you, for example, you're in business and maybe you want to join to a new product, you want to switch to change to a new product, whatever you incurred, your past is irrelevant. You get it? Is irrelevant. Unless maybe you have some maybe remaining scrap things that you're going to sell when you switch to another. Now, that would be a relevant revenue. You get it into your decision. But if it's a cost that you will not recoup in any way possible, then at the end of the day, you take that to be irrelevant. You get it? Huh? Yeah, so it's very important for you to understand that. And then we have also what we call the committed costs. Committed costs. Now, committed costs could be, for example, I think, there are certain supplies or maybe suppliers that may ask you to make a deposit. You get it? Make a deposit on a certain purchase. It could be, for example, maybe today you're in a place and you already paid pre-rent. You paid a prepaid rent for the next year, 2022. And you have to, the landlord, according to the contract, the landlord cannot reimburse this money to you. So you have to, and you maybe want to make a decision to moving to another new place. Maybe you've gotten a better match place. Now you will not, definitely, because the other is a committed cost, you will not have to consider it because you already incurred it and the landlord will not pay you back that money. You get, so it's a committed cost already. Right now, you cannot be able to get this money back at any point in time. So it's very important for you to know that. And then we have what we call the non-cash flow costs. We have what we call the non-cash flow costs. Now, I know some of you know very well, maybe you did a financial accounting one, and we have costs, the ones that we call notional costs. We have what we call notional costs. Now, notional costs, these are usually costs that are charged by management on maybe a head office management on, let's say, different branches. If just for allocation purposes, I'll give you an example. If I'm a management accountant for, let's say, Stanbic Bank, and let's say today we are trying to allocate maybe the salary of the CEO. What will happen is we shall charge, let's say 10%. We shall charge, let's say 10% onto branch A and 10% onto branch B and 10% on another branch. Now that cost will be notional in nature, because in reality, this branch is not going to make this this payment. You get it? But it is notional in nature because we're just trying to use it for performance evaluation to see if at all each of the branch was paying 10% of this salary, what would it really happen? So when you're making a decision, notional costs are excluded because in most cases they are not realistic in nature. Because ideally, you cannot tell me that branch Arua will pay the same portion of the salary like the way maybe branch Kampala will. You get it? Because they're in totally different locations and they're generating different revenues and so on. So it's that notional in nature. You get it? Huh? And then, of course, the other cost that is also non-cash flow is depreciation. You know, with depreciation, it's just a provision for wear and tear, where an organization can say maybe 10% for motor vehicle and so on, and then 20% for maybe another asset and so on. So ideally, the cost itself is it's non-monetary. It's non-monetary in nature. You don't pay for depreciation, yet you recognize it as an expense within your books, but you ideally don't pay for it. You get it? Huh? Yeah. So it's very important for you to have that in mind. So sunk cost, committed cost, non-cash flow, all these are irrelevant. When you see them in a given scenario, consider them irrelevant. And then we have, of course, the general fixed overheads. We already spoke about fixed costs, that these costs don't change with a change in decision. So you regard them non-relevant. You get it? Or irrelevant costs, because they will not change. Either you take the decision, it's just like the rent of the place where you're staying. Either you, for example, either you're going maybe to do which course, whatever it is, you still incur the same thing. Meals, clothing, your costs, you not say that because I'm going to do the other course, this will change compared to what I'm maybe dressing. You get it? Unless maybe it's a professional specific attire. You get it? Huh? Yeah. It's the same thing with business. The warehouse, you're not going to terminate a CEO. You get it? Because of a given decision and so on. And then we also have what we go regarding to net book values. Now, similar to what we just talked about, our non-cash flow costs. Remember, these net book values, one, they have already a past cost of the cost of let's say for the motor vehicle or the cost of the building and so on. Then next we are deducting, net book values cost minus accumulated depreciation. So you're going to deduct a depreciation, which is also non-cash flow. So in that case, the net book values will also not be relevant because they are also just, these are a result of the accounting conversions. And it's basically, there's no cash flow that is happening. You get it? Yeah. Then the other is unavoidable costs. Like we saw up, avoidable and escapable costs of that nature would be relevant. The same thing that is happening here. Unavoidable costs that you incur either you make the decision or not. You get it? Unavoidable costs are considered to be irrelevant for any decision making. You get it? Huh? So I hope you're trying to get something here. Now we want to look at after we've tried to understand the different statistics of relevant and irrelevant costs. Now we are going to go detail for each of our, let's say, our variable costs. You get it, eh? We are going to go detail for each of our variable costs. Now, our first variable cost that we are looking at is materials, raw materials. So ours is to ask, when is a cost for raw material relevant to us? You get it? When is it relevant to us? Now, you have to know that materials we can have three scenarios. We can have three scenarios of materials. Either the materials have been bought before, so they are within the warehouse, or these materials are actually going to be bought. Now we have cases where we're saying that if the materials are already purchased and will not be replaced once the relevant cost of using them is, okay, we're saying that once the materials have already been purchased and will not be replaced once used, the relevant cost, we compare two things. We compare the current resale value. We compare the current resale value, and we also compare the value they could obtain if these were put to alternative use. Now, why are we bringing in this? Is because these materials have been purchased and you not, of course, they will not be replaced. So you're not going to replace them. Maybe, for example, I'll use still the example of our special order of us producing, let's say, 300 cakes at 40,000 when the normal price is 50,000. So we are saying that if part of the materials, maybe the wheat flour and so on that we had bought, that we are going to use in this order, had already been purchased, you get it, and will not be replaced once, of course, is used. Maybe it only relates to, it's only specific to that. So we are trying to look at their current resale value. How much can we resell these materials, just in case we don't, we don't use them for this order. And then the other that we are also looking at is what value can we obtain if we are to put this to alternative use. You're asking yourself because you want to get the value, you get it. I think as you can see, alternative use, we are looking at opportunity cost. Still resale value, this is also futuristic in nature. You're looking at how much you will earn in case you resell this, you get it. So we are trying to look at what's the alternative use in case we are not going to use them. And then the other is we are trying to look at is what if the materials are in continuous use. By continuous use means that these materials are can be used for another product that you can continuously maybe produce in your company, you get it. So because they're in continuous use, once you use these materials for this contract, you will need to replace them. You will need to replace them. So in this case, since you need to replace them, it means that in this case, the replacement cost will be your relevant cost. Your replacement cost will be your relevant cost, because after you've used them for this contract, you definitely need to replace them. So the value at which you replace them will be your relevant cost. Now, there are cases where you have to understand why we're using the word replacement here, is that there are cases where you bought those materials at, let's say, a lower price. For example, it could be wheat flour. Maybe you bought a packet at, let's say, 5,000. But maybe because you have had this maybe within your warehouse and prices have now raised to maybe to 7,000. So you take the 7,000, because ideally, if you replace those materials, you no longer incur the 5K, but you're going to incur the 7,000. You get it, huh? Yeah, so it's good for you to understand and have that in mind. You get it? And that's why we use the word future replacement cost, not the cost at which you bought the materials. You get it, huh? And then we have cases where the materials are not in continuous use, where the materials are not in continuous use. Now, here means that these materials are like, for example, like they are scrap. You're not going to use them for anything else. You get it, huh? And we are trying to look at if they are, for example, in scrap in nature, the relevant cost here, we're trying to look at the higher of the salvage value, the higher of the salvage value. The word salvage also means scrap. So the higher of the scrap value, the higher of the scrap value, the higher of the scrap value, and the value for alternative use, and the value for alternative use. You get it, huh? Yeah. Yeah, somebody is trying to ask here, saying, I'm not getting the difference between committed and unavoidable costs. Okay, I just want to clarify something small here. Now, of course, they have similarity in them. You get it, huh? They have similarity in them. But what we are saying is committed. I gave you an example. It could be already a contract you signed. Maybe, for example, you already signed, it could be maybe a contract with a telecom. And maybe this telecom has been supplying to you internet. And maybe you pay them for the whole year. You get it? You pay them for the whole year. Now, when you're switching to another, let's say another telecom provider, or you're actually doing away with that kind of service, maybe you're already installing maybe your other internal system to provide you with that same service. The other will be already a committed cost. You already committed yourself by signing that contract. You get it? So that is what committed comes. So it could be a contract you already signed in. It could be already an advance payment you gave in. You get it? So it means that even if you take the decision or not, that cost is still needs to be paid. You understand? You already have, you have to make sure that you make that. Now, for unavoidable costs, just to distinguish them slightly, but like I'm saying, they may, a committed cost may be an avoidable cost. You get it? But for just distinguishing them here for learning purposes, unavoidable costs, like we've indicated, these are costs that you will not do away with. Either you make the decision or not. They are basically, they could be committed costs, or they could actually be recurrent costs. You get it? They could be recurrent costs. So unavoidable costs can be past or recurrent costs. I'll give you an example, like the cost of your fuel to work, if you're a person who drives, even if you're switching from job A to job B, unless maybe the condition that for the other job, they'll give you a canned fuel, this will still be the same cost. You're still going to incur fuel. Even meals, you will still going to have meals at home. You get it? So unavoidable costs are not part of your decision, and they are considered irrelevant. You get it? So it's just for you to basically. So the difference is that unavoidable costs can also be futuristic, but these are unavoidable. They are not dependent on the decision. Either you make the decision or not, you still have to incur such costs. You get it? Yeah. So I was still around materials, and I was saying that if materials are not in continuous use, you don't use these materials for your day-to-day work. You get it? Huh? Maybe they don't relate to the kind of products that you now produce. We are saying that we look at the higher of the salvage value, which is the scrap value, and then the value for alternative use. The value for alternative use. Just in case, if these are like papers, maybe paper, just paper, you might have all this paper within your company, and maybe this paper now, because of this contract, this paper is going to be used for something. You get it? Maybe it could be maybe somebody is going to make paper bags out of it. You understand? So we are saying that if you don't use this, yours is not in a business of paper bags and so on. So if you're not going to use these papers in continuous use, if you're not using these papers in continuous use, then the relevant cost will be the higher of the scrap value. Just in case you don't use these materials, that means you have to sell them or use them again for another alternative use. You get it? So that is why we look at the higher. So the higher of that takes precedence. Then the last scenario is if the materials had no resale value. If the materials have no resale value and no other possible use. If the materials have no resale value and no other possible use, then the relevant cost of using them for the option or opportunity under consideration would be zero. Would be zero. Now, if, for example, we have that same contract or that same order from a specific client for us to supply maybe those 300 cakes. But ideally, one of the materials, maybe it could be boxes. Those boxes cannot be used for any possible use and they have no resale value. No one is interested in them. Now, once we use them for that specific contract, in that case, we shall not cost them any value. Their value will definitely be zero. You not go back and say, now I bought these materials at let's say 20,000 each of them, so I need to cost them. Even if you cost them, or even if you don't use them, they are no longer, they are scrap in nature. So when you're making your decision, in this case, these materials will be valued at zero. I think we shall look at an example and see how that plays. You get it, eh? And see how that plays. Now, that is materials, but I want to give you a scenario for labor. I just want to give you a scenario for labor here. So we've tried to understand materials. We've tried to understand how materials work. Now I want to give you a scenario for labor. Now labor, these are your workers. These are your workers who are going to deliver the contract. Now, remember, ours is to look at the decision of maybe order to supply 300 cakes. You get it, eh? At 40,000, and we are saying that the normal price is 50,000. So what cost will you consider for labor? What cost will you consider for labor? So we have two scenarios here, or several scenarios. Now, one is when you have idle labor. You have idle labor that you're paying. So you have idle labor that you're paying that can actually execute this contract without any additional salary, without any additional pay. You get it? Without any additional salary and without any additional pay. Now, your relevant cost for such a scenario will be zero. And the reason why it will be zero is because either you take on this contract or you don't take on this contract, you still have to pay these guys a salary. You get it? So that is why we are saying if we are make a decision on taking on this order, if labor is available, that should be something for us to just consider to be zero. So the relevant cost in this, now in reality, of course, labor is going to be involved in executing this, but to you as a company, we are saying that the cost of this labor will be zero because you're not going to pay anyone any additional salary. You get it? Huh? Yeah. So you could have maybe you could have labor. Labor will work for extra hours. Will work for extra hours. Now, in this case of labor working for extra hours, we are saying that you have existing labor. That labor, already you're paying it a salary, but because of this contract, they are going to work extra time and you have to pay them, and you have to pay them overtime. And you have to pay them overtime. Now, the relevant cost for such a scenario will be the overtime payment. Will be the overtime payment. Only that will be the over. Now, the reason why I'm only taking the overtime payment is because it's the only additional cost. This labor, you're going to pay it a salary. Either you take that contract or not. But because of taking this contract, there will be an additional payment of overtime payment to this labor. So this will be your additional cost, which we regard to as our relevant cost. I'll give you another scenario. Another scenario is where you're going to hire new labor. You're going to hire new labor for this contract. Now, in that case, hiring new labor will be now the actual cost, the labor cost for this new labor. It will be the labor cost for the new labor. It will be the labor cost for the new labor. Because you're hiring this labor for specifically this contract. You get it? So it will be the labor cost for this new labor. So as you can see, whatever we are making, whatever we are considering to be relevant is only that cost that relates to what is going to happen after we've taken on this contract. You get it? So there's nothing either we're taking on the contract or it's after we've taken on the contract. We are not looking at the current payment that we are making to the labor. We are just looking at the additional cost. You get it? And then if we are trying to look at another scenario. So scenario one is where we have idle labor. Scenario two is where labor will work for extra hours. So it's overtime payment that we shall look at as a relevant cost. Then we have the hire new labor, the labor cost for this. Now, we have cases where current labor will switch. Current labor will switch effort to new contract. Current labor will switch effort to new contract. Now, if current labor is going to switch effort to new contract, means that they are going to forego their current effort on another product. If they are going to divert their effort from another product, then in that case, the relevant cost will be the opportunity cost. Will be the opportunity cost foregone. Are we together? It will be the opportunity cost foregone. Now, if this labor was going to produce, let's say, bread for a business type like this, we shall look at how much would we have been able to get in terms of production of bread from this labor. and that will be our relevant cost. You get it? That will be our relevant cost for this specific contract. So we shall look at the cost we are going to pay that labor and as our relevant cost for the scenario. You get it? So that is what would happen with labor, and that is why we are saying we are summarizing it by saying it can either be the replacement cost, it can either be the incremental cost, it can be the hiring cost, or it can be the opportunity cost. You get it? Yeah. So it's very important for us to understand that. Like you've seen here, they're saying if the order under consideration necessitates the transfer of employees who are fully occupied on existing job and yet making a contribution, if affected, the company will register a loss, like the loss I've just given you. This loss contribution is always a relevant cost for decision making, which we've called the opportunity cost here. Because if they are moving, for example, from bread, the revenue from bread is like an additional cost. Yes, the contribution that we are going to lose from the aspect of bread is an additional cost for us. You understand? It's an additional cost for us. So it's very important for us to reflect on that. And then we have what we regard to as cost for overheads, identifying relevant costs for overheads. Now, overheads, we say that only direct attributable overheads are relevant. Remember, these that we've looked at, labor, materials, these are basically, these are direct costs, these are variable costs. Now, we're saying, what about overheads? We are saying that only directly attributable overheads are relevant for decision making. Non-cash overheads, fixed overheads, and general overheads are irrelevant. You get it? Yeah, so it's very important for us to have that in mind. So I hope we are following, and I hope we are trying to get something. We're just going to take a break of 5 minutes. Somebody told me that we need to have at least a 5-minute break, always in the class, for people just to excuse themselves a little. So let's just have a 5-minute break and return at 2018.